Good afternoon. Hi, Duff. It's Dan Gross here. I'm for those of you watching, the Money Box columnist at Slate and the Money Culture columnist for Newsweek magazine.
Hey, Dan. Duff McDonald. I'm a contributing editor at both Condé Nast Portfolio magazine and New York magazine.
In other words, the lord of all things business glossy coverage in New York City.
And you're the lord of all things online weekly. Online and weekly.
Go. I think you have the bigger expense account then. Can we just before we start? Am I correct to understand that you're Canadian?
I am indeed Canadian. I'm from Toronto, but I have married an American, and so am legally allowed to stay in the country.
Well, I want to offer my condolences then, because, I think perhaps one of the greatest living Canadian businessmen was sentenced to jail today, that being former newspaper and media mogul Conrad Black.
Conrad Black, who I've got a little bit of a history with him. I wrote a story in Vanity Fair about him in 2004 called The Rise and Fall of Conrad Black, and which sort of charted the controversy he was embroiled in, at least up to that point. And then in the last week, I actually ran into Conrad in Palm Beach, and
I assume your winter homes are adjacent to one another.
Yeah, we share the same tunnel under the road to the beach. But I ran into him at the Brazilian Court Hotel and asked him what his thoughts were, and he was entirely unrepentant. Although today I gather he voiced a few words of respect for the court, he still vows revenge on the people he considers his enemies, and basically what he thinks is the fraud at Hollinger, which was the company he was involved in and ran, was not his own, but rather the investigation of him. So.
I should note he got a reasonably stiff sentence. I think it was from somewhere to 78 to 97 months, and the crimes of which he was convicted generally involved kind of looting a public company. One of the interesting things I noted, the Financial Times had a little bit last week, that when people like this are about to be sentenced, they get their friends to write letters telling the court how wonderful they were. And in Conrad Black's dossier, apparently there were letters from both Rush Limbaugh and Elton John, which I think that probably has to be a first in terms of those two pop culture figures being on the same side of an issue.
Well, the funny thing is when I wrote the Vanity Fair piece a couple of years ago, I did try and make the point that it's a shame that Conrad Black chose to do what he did, because he is someone with a gigantic brain and remarkable and entertaining eloquence. So he's someone that no one, even his most vituperative critics, would deny is a great addition to a dinner party. So it's kind of sad.
Well, any guy who writes a very admiring biography of FDR can't be all bad. Now, as I'm sure you have, I've spent some time with some well-known people who have been great successes in the business world, who have ended up in jail late in life. I think, in my experience, it's been a generally rather chastening and somewhat humbling experience. They emerge with a sort of newfound concern for the plight of the people caught up in the justice system. I suspect that Black is going to be one of those people who comes out exactly as he went in.
I wouldn't be surprised. I think he'll spend his 6.5 years writing using his 20 or 30 or 50 cent words a encyclopedia-length attack on those who brought him down.
Right, so who does Canada have left now in terms of big time moguls?
The Thompsons.
Yes.
Who bought, I guess, Reuters recently.
Right, exactly at the top of the cycle. Good for them.
They have the Westons, who I think are at a slightly smaller degree of wealth, who own the Loblaw grocery chain, a number of other things. They have Peter Monk, the gold guy from Barrick Gold.
Right, but she's known in our circles as the father of a financial journalist, I think.
Exactly, Nina Monk's father. They have Frank Stronach from Magna.
Was it his wife or daughter who was hanging around with Bill Clinton?
That would be his daughter, Belinda.
Okay.
But she also has recently dated a man named Ty Domi, who for years was the enforcer on the Toronto Maple Leafs. So she
before he was on the Rangers too, right?
Yeah, so
New York Rangers.
So she'll go from one end of the intellectual spectrum to the other. So
right, from soft power to hard power, if you will.
Yeah, and I'm not going to call myself an expert on all things Canadian, so I'll leave it at that.
Okay. So, what do you make of what's going on in our world now, specifically these repeated, and I know you've worked on Wall Street and you write about this stuff a lot. I have not worked on Wall Street, but write about this stuff a lot. But I guess I should stop being amazed that these banks come out, like UBS came out today and said, our capabilities of judging credit risk are so bad that we've got to write down $10 billion of our assets. And by the way, we need money so badly we're going to have to sell a bunch of stock, perhaps at a discount to somebody. And the market says, great. The stock goes up. Dow is back near where it was in October. And we've seen 5, 6, 7, 8 or 9 times this happen with the biggest names, Citigroup, etc. And I continue to be surprised that the reaction is positive. Do you have the same kind of cognitive dissonance there?
Meaning the bad news is behind us now. Let's celebrate.
The credulity of the sort of market and investors to say, okay, we know you really screwed up. We know that credit conditions are deteriorating throughout the economy, but as what you've told us, that sounds pretty good, and let's go forward.
Yeah, I think that's definitely a symptom of a sort of the sickness of optimism, which is everybody's always looking for great news in the markets. And they'll try and put positive spin on bad news, just the way that any politician or administration will. And we had a piece in New York recently called "The Catastrophist View," which sort of outlined a fairly negative and dire outlook, which suggested that this is just the beginning. This is sort of the start of the great reckoning of the American borrow and spend boom. So I actually, from the reporting I've done, the people I've talked to on the subject, am far more pessimistic about what all these revelations mean and what all these sort of credit products of rapidly deteriorating value suggest. I think it means that the faith in the ability of the American borrower, whether that's a homeowner or a company or the government, to repay, is in decline, and there's nothing to celebrate about that at all.
I'm with you, probably 98%. The blogger Atrios has whenever there's some credit news, he posts and he refers to it as a big shit pile, which his kind of catch-all term for the credit mess. And working for family publications, I I can't use that quite so much, but it is clear that there are, steaming piles of bad debt, and it's, I think what's amazing to me is we get a lot of attention paid to all this funky stuff, the SIVs, the buyout debt, the things that are not so easily intelligible. And what's being overlooked is just the good old-fashioned debt that is now going bad. Student loans, credit cards, auto loans, those all seem to be going bad, as they do whenever there is a turn in the business cycle. And yet there is this presumption that, everything is generally okay and that there won't be reactions down the road. One of the more interesting pieces I thought was there's an article in the Wall Street Journal, I believe it was over the weekend, but it was about how the culture of easy credit has met the culture of narcissism. And people essentially finance their boob jobs and plastic surgery and all kinds of cosmetic surgery are basically financed the way, people finance car purchases, and that the providers of those services, which are discretionary for everybody but Hollywood actresses, the demand seems to be slipping even for that. So when Americans start to cut back on Botox and find that they just don't want to borrow at 20% for some facial surgery, I think that's a pretty good sign that things are going badly.
Yeah, and don't forget the other ingredient in there that you didn't mention, which is plain old corporate debt. We've been focused on mortgage debt for the better part of 6 months, and a handful of stories have come out talking about commercial real estate and credit cards, like you say, but corporate America, which may not be as big a borrower as the mortgage industry. Actually, I assume it's not, but they bore the lending standards there got just as loose as anywhere else, and we could be on the cusp of a default cycle of major proportions in all corners of the economy. The one thing that I do find interesting about this, though, is if you read the international press, particularly British press, which I try to keep up on, they have a remarkable tendency to refer to this as an American credit crisis. But it strikes me that in a number of industrialized countries, we may have a global credit issue on our hands that's brought about not just because American borrowers overspent, but because real estate markets all over the planet boomed. And while we take the brunt of the good news in good times, we're taking in the brunt of it in the bad times. But I feel like the entire planet had loose lending standards for a while, and it's coming home to roost.
It's possible. I think part of what Blogging Heads wants is disagreement. So let me just say that I've heard terrible things about you, and if I see you on 57th Street, I'm going to kick your butt, and we'll get into it then. But I would disagree with you to a degree on some of these credit issues because, they always say Wall Street is based on the greater fool theory, that you can sell your assets to a greater fool. And what we saw with Citigroup a couple weeks ago, they needed to raise some more capital. They went over to, I believe, Dubai, and they did a deal with a convertible stock, and everyone made a big deal about how they were paying 11% interest. And then some people crunched the numbers and said, if you look at it and the fact that there's an embedded option in here, their cost of capital was sort of LIBOR plus 150 basis points. In other words, not too out of line for what a big bank should be borrowing at. And to me, that indicates that, we have, and Americans are always great at discovering who the next greatest fools are. We have discovered them in the form of these sovereign wealth funds. Blackstone sold 10% of itself to the Chinese sovereign wealth fund it promptly fell 30%. And I think we're going to see this kind of time and again. There's a huge new source of buyers, people who are desperate to put their money into something, who are comparatively unsophisticated, who like American assets and American markets. And perhaps some of the optimism surrounding the Citigroup deal and that we've seen surrounding the financial sector since then, perhaps some of it is justified because in comparison with prior recessions, when we didn't have these other alternative sources of capital to shore up struggling institutions, and many failed, or they found themselves having to cut back their lending, it seems like we can now tap into this whole new breed of investors. And I have to write about this week, and that's kind of where I'm going. So tell me why I'm wrong.
So the greater fool is the Saudi who buys Citi at a discount.
Well, at a discount. Well, they bought it at a discount, but with a pretty high yield, right?
Sure. I think I agree with you that Wall Street has proven itself exceptional at finding the next sucker, sort of as evidenced by Ben Stein's columns recently on Goldman.
I think that's more of a case of the New York Times finding its next sucker.
Yeah, but like the whole issue there of Goldman shorting certain securities they're packaging and selling, but I think that this is everyone on Wall Street tends to convince themselves they're geniuses in a rising market, which is how we end up facing these absurd pay scales, not only at the top but down all the way to the sort of rank and file at any of these investment banks. And I can tell you from having worked in one that these people, while they may have had good educations, are no smarter than any journalist I've worked with. And the challenge that they face is when they run into sort of more volatile market conditions and have to lay 20% of their people off because the smart bets they'd made ended up not being so smart after a while. I think we're in one of these situations where Wall Street in its entirety got caught sort of wide-eyed at this credit crunch and not knowing what to do. And a lot of several of these banks are being exposed as sort of being exposed to risks that they probably shouldn't have been exposed to at all, or at least to that degree. So I don't know if you want to try and spin it that, and now they're turning around and selling to the suckers, go ahead. But I think that these guys are, everywhere. Goldman notwithstanding, they had a substantial write-down of credit assets in their third quarter. Every single bank on Wall Street, all the major banks have suffered in the area of billion-dollar write-downs. $1 billion of mistakes. And so we've got a bunch of people here who, while just like in the hedge fund industry, they never have to give their money back for the past years when what we see in retrospect was apparently artificial prices getting pumped all the way up, and these guys getting paid as a function of those prices. They're not going to have to give that money back, but all of a sudden, they're not all so smart anymore.
I agree with you on that, but I think the difference is between now and, say, when we had the S&L crisis, when, if American banks got into trouble, the only place they could get cash from at that point was really the American government and the taxpayer, which is, what happened. Whereas now there is and when Citigroup got in trouble, I guess in the 90s, they had to turn to a Saudi prince. Now there are the equivalent of a lot of Saudi princes out there in, these sovereign wealth funds and private equity funds around the world, in places that, we didn't think of as potential pools of capital even, 4 or 5 years ago. And that may have the effect of, I think a lot of what's going on today, whether it's this subprime, deal that was allegedly worked out, or some of these efforts to raise money, is about kind of kicking the can, putting off the final reckoning for another 6 months, for another year, for another 2 years, in the hopes that things sort of improve. And I think that a lot of this cash that's around the world looking for a place to play is going to help shore up a lot of these institutions to a degree that they would not have been available 5 years ago, 10 years ago, 15 years ago.
No, that's right. That strikes me as totally correct. That's the benefit of global money flow. And
absolutely,
if Chavez doesn't want to give us his oil money, the Saudis and the guys from Dubai and Oman and Qatar and Abu Dhabi will. So yeah, it's great that there is money available to stave off bankruptcy of major financial institutions in the U.S. However, you've got previous equity holders who are obviously experiencing severe dilution now. Which is the result of some sort of decisions made by the people that they entrusted to run those banks.
Right, but judging by the way the stocks of like Citigroup and UBS have reacted, they seem pleased to be diluted.
Yeah, I guess it's better to be diluted than to be broke. In this previous bit that we were just talking about, you alluded to this Ben Stein piece in the New York Times about Goldman Sachs, which I confess I did not read in its entirety, and that hasn't stopped me from talking about it. Can you just kind of break down A, what he said, and B, the most sort of absurd or outrageous thing about it? Well, the question that Stein raised is, and he spoke specifically of Goldman, but in principle the idea was, and he hearkened back to the Merrill Lynch example of Henry Blodgett with having buy ratings on tech stocks that he had no respect for, which was, is it acceptable for an investment bank to be packaging and selling mortgage or debt securities to clients while at the same time having a negative opinion and or shorting those same securities? And I think a simplistic view would say, no, that's not right. You're selling me something that you think isn't worth it or is worthless. Right. I'm inclined to sort of go the other way and suggest that, when you've got an institution of the size of these Wall Street firms, part of their business is actually the mere packaging and selling of securities. And they don't actually need to have a view on that. They are just facilitating for their clients. And they can have their own point of view. However, on the other hand, it's obviously, this is not your neighborhood antiques dealer or butcher or what have you, where you walk in and you're inclined to say what he's selling he thinks is of quality and of value. So what Stein brought rise to is sort of the whole issue of what is Wall Street? Is it merely a bunch of guys making money any way they can, up, down, in, out, left, right, buy, sell, and they will incline their customers to do whatever will make the sale? Or are you supposed to think that they've got your best interests at stake? I think the answer in the end is that everybody knows that all these Wall Street firms, all their clients know that while they may be customers, the customer doesn't come first on Wall Street.
Right, but what didn't Ben Stein also go on to say in that he thought he was pointing to sort of research pieces put out by their chief economist, who, I know for someone who's been a source of mine many times, basically saying that he was putting out this kind of macroeconomic commentary, talking about the potential for debt to be going bad, while the, prop desk was shorting subprime stuff, and then there was some connection there, even though he had, there was no evidence to back that up, and even though I don't think there's much evidence to suggest that the people on the prop desks are big consumers of the type of, macroeconomic research that is put out by their research arms.
Sure, but Dan, you can, these firms can get. I'm not a defender of Goldman in any sense. It's obviously a firm with a great reputation. But these firms will get criticized for any way they do that. If you've got an economist who's bullish and a prop desk who's short, then you call it a contradiction. If you got an economist who's bullish and a prop desk that's long, you say, wait, you're trying to pump up public demand for a position you've already had. So they can't win either way. I think that's sort of a simplistic aspect of what Stein was talking about. It's like, these firms are so large, they're going to have positions or opinions, in similar or contradictory directions all the time. I think what's most interesting about the whole Goldman thing, though, recently is, they dodged the third quarter meltdown that pretty much everybody else seem to have fallen victim to, and we're now in a goddamn when are they gonna take a hit mode from competitors, from media, from anybody. There has never been, if Wall Street used to be a series of targets, Wall Street, there's no good target left other than Goldman.
That's true. Now, with this Ben Stein thing, I'm mostly angry that, he gets to kind of fling about wild charges, because I did a column for that section for about 4 years, and I couldn't get away with any of the crap that all sorts of other publications let me get away with. They made me verify things, and if I tried to use certain analogies or metaphors, I would be prohibited from doing so. And he seems to be able to do whatever he wants. I think part of it is because they think not many people take him seriously. He's there primarily for entertainment value.
He's certainly in a bit of an envious position. I agree with you. Although I have no complaint with either of my two homes now, New York and Portfolio. While both will demand some substantiation and won't allow me to make claims that came to me in a dream, both of them will allow a degree of flexibility in writing that I think a lot of newspaper people would love to have.
I'm sure Adam Moss is watching right now and smiling.
Hey, Adam.
You spoke about Goldman, about how they managed to dodge all these bullets. They managed to prosper where everybody else failed. And it's clearly because everybody there is a genius, lives to the age of 130, is kind to small animals. There's this, I think, this mystique / aura about Goldman, part of which rests on the fact that they don't let too many journalists in to come tell stories. They don't push news out to people. They generally don't cooperate, comment on the record, and as a result, you have, on the one hand, this fabulous success, and on the other hand, this kind of great mystery as to how precisely it's done that creates this sort of aura. Now, I know you worked there for a period, right?
I did. But to your point, I think, let's not put the cart before the horse here. I think the mystique comes from their never-ending profitability levels. This firm has made so many people rich over the past decades. And, you know, if you look at the, 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 you know the mystique for journalists comes from the fact that not a lot of us get through the doors there. I wrote a piece for New York Magazine a couple of years ago on Goldman's bonuses, which caused a bit of a kerfuffle, and because it was the first time that anybody ever discussed the Goldman bonus process at great length. But I think what the mystique has become now is, if everyone on Wall Street took the bait in this credit boom and in the process of packaging took exposure themselves, how Goldman managed to dodge that bullet is a huge mystery. There's also the ongoing rumors of Goldman being in conflict with its clients in terms of trading for its own account against or ahead of customers. But none of that's ever, there was a piece in the Times today about that Goldman guy that Giuliani arrested back when he was a prosecutor. But, none of the other stuff has ever come to anything. And basically, at best, it's rumor. It could be fact, but nothing's ever come from it. So basically, you've got a situation here that's a firm that hires great people, that's done a great job of making a huge amount of money, and in the process created a great deal of envy. And the net result of that is a never-ending speculation of how the hell these people do it.
And the stories, I've seen several stories in the last couple weeks that really focus on saying, Goldman, they don't just reward the people who take the risk, they reward the people who control the risk. That the risk control function there isn't seen as sort of an annoyance or someone who is constantly handcuffing these brilliant, intuitive traders. It's a function where the people there get paid as much or almost as much as the people doing the trading itself, and that is sort of a value within the firm that has led them to avoid some of these blow-ups.
I would bet you that perhaps David Viniar, the CFO, makes as much or almost as much as the traders, but I doubt it trickles down. I'm not sure the controllers or accountants in each division are making as much as their star traders, but certainly the partners who oversee the risk side of their balance sheet definitely are rewarded well. It's a truism in any business section, particularly in New York. If you got a Goldman story, it gets people excited, and it probably will for quite some time.
Speaking of Goldman and bonuses, I think there's concern in New York now about what kind of bonuses will be paid out this year. I did my piece in Newsweek, which has hit the stands today, about what I call New York's winter of discontent between the stagehand strike, the television writers strike, all these credit problems. Citigroup is rumored to be planning major layoffs. They're the largest private sector employer. The Bloomberg administration in October already ratcheted back their expected revenues for this fiscal year and next. They're ordering budget cuts, and a lot of it has to do with the plummeting profits of financial services. There's some signs that even real estate is starting to maybe keel over a little bit. And New York has been really blessed in recent years that it has this incredible concentration of financial services jobs, about 9 or 10% of the jobs, about 30% of the wages, and all the trickle-down effects of that. And so it leads me to the question of, if things go badly, or if Wall Street has another, this year may end up to be a mediocre year, but if it has a poor year going forward, or if it just doesn't have much growth, how screwed is New York City, which has come to rely so much on Wall Street for jobs, for tax revenues, for everything else?
Well, you alluded to the trickle-down effect. In in that recent New York piece on the catastrophist view, we talked about estimates of for every job loss on Wall Street, there are 2 other jobs lost in New York.
One of them is at a strip joint.
One, let's be realistic. What for every 5 Wall Streeters, maybe one is at a strip joint. But 2 extra jobs, and those are generally service industry jobs or, real estate or what have you. So you mentioned Citibank. There's also Merrill Lynch, which is going to be having huge layoffs, and they've got to be in the top 10 employers in New York. And we're seeing huge numbers at various banks. The interesting thing that someone, Peter Schiff, who is an economist at a brokerage called Euro Pacific Capital, brought up to me is he said we're at risk of even further challenges, which is if the tax revenues fall off as a result of this, which they almost invariably have to, then you have budget cuts in things like police on patrol or street cleaning or if you recall, like in New York, I think it was like 5-6 years ago, they suspended recycling because of how affordable it was to, from once every 2 weeks to once a month or whatever it was. And the city became instantly dirtier. And so there's quality of life challenges like that, but certainly the budget. Bloomberg's going to leave his successor with a deficit. And if they're cutting, here I am up here in Bronxville looking at this great deal they cut for the MTA where they kept subway fares flat. I don't even use the subway. And I'm going to pay a little more on the train, but if they insist on holding certain things like the subway or even taxi fares down, they're going to have to find the money elsewhere. And I think that New York is going to be in for some sort of strict budgetary times. I guess the only thing under holding it is going to be if the dollar keeps falling like a rock. And again, we'll have all these European tourists spending money. So at least Fifth Avenue will be fine.
Right. And that's the argument of the sort of U.S. economy writ large that you hear from the optimists is that, domestic demand may be in the crapper. Nobody can really afford to buy a house or high-end services. We have some challenges with the job market, et cetera. But, we can kind of export our way out of this because the dollar is so weak and the rest of the world is booming. In the New York City argument, it's, okay, so other Americans may not be coming here to pay $150 for a Broadway ticket. We might not be buying the real estate, but all these Europeans and Russians are. And, there is something to that. Well, I walk through Rockefeller Center every day, and it is, wall-to-wall Europeans. You go in the park, everyone in the horse carriages is European. I had interviewed a developer about a month ago who had put up a speculative condo building right near Rockefeller Center, and he said, and again, you can only trust real estate developers so far, but he said that he didn't even bother to market it in the U.S., that he sold them all to people in Ireland. And so there's this sense that, regardless of what's going on here, the combination of this weak dollar and the fact that there's a lot of money in this global economy and that's having a lot of growth will somehow tide us over to such time as we get healthy again. And I think that that could probably be maybe 1/3 true.
I guess so. I think that selling your real estate out from under yourselves to foreigners isn't exactly something to celebrate. But I was speaking to my sister just yesterday, who's in Canada, and the Canadian dollar rose above the U.S. dollar for the first time in 30 years a while back. And the very day that the New York Times wrote about Canadian spending in the U.S., I got a call from an old high school friend asking me if I'd buy him a ring at Tiffany for his wife and get it up to Toronto somehow. But, point being...
Well, that's the ultimate sucker's bet.
Yeah, I spoke to my sister yesterday, though, and she pointed out that the Canadian dollar had actually slipped back below the U.S. dollar. And so I think the span there was about 3 months. And I said, how do you feel about it? She said, well, it was nice while it lasted. We felt pretty good.
But the ultimate sucker's bet is buying a diamond at Tiffany's, because you go down to 47th Street, and if you call me afterwards, I'll give you the number of a guy. He'll give you the same thing that they have at Tiffany's for half off.
So you're one of those guys who knows a guy? Is that you?
Yeah, absolutely.
But as far as exporting your way out of the situation, sure. Like a currency move, you and I talked about this before. A currency move in either direction has its positives and its negatives. And definitely, the U.S. is going to enjoy some serious export growth in the next little while, although I'm not sure how much that's going to help New York. In terms, it's not like we have a lot to sell other than our great ideas. And you can see where our great ideas just got us. Yeah, like it'll be good for the trade deficit, and but we're obviously going to have to keep an eye on the dollar in any case, because you get every single optimist is telling you that this is a cyclical, not secular decline in the dollar. But on the other hand, who's to say? We just
cycles have a way of turning into secular trends.
Yeah, like we just borrowed our way to the biggest party this country's ever seen, and with the Chinese and other sovereign funds saying, you know what, we're rethinking our commitment to the dollar here. So yeah, that may be cyclical in the sense of they were buying it, now they're selling it, but. It's difficult for me to find a huge amount to be optimistic about with a falling dollar, an economy sort of teetering into recession, a financial system exposed as packagers and marketers rather than actually smart people doing smart things, and an economy that sort of doesn't know which way it's going to go, and the only upside tends to be when we get a revision next quarter that tells us that. But
Duff, I was watching CNBC, and they said this is a good time to buy stocks.
Well, there you go. CNBC.
I can't believe how pessimistic you are.
If we don't buy them, what the hell is CNBC going to do? So, if you care about Maria Bartiromo's job, buy stocks.
Well, with that, being a fellow suburbanite and hence subject to the demands of Metro North's train schedule, I'm going to have to run.
Great talking to you, Dan. Lots of fun.
All right, we'll do this again soon.
Okay.